Hello, Temi Tope and Index and Forex CFD trader. Great name. Did well to fit it in. How is everybody out there? Yeah, are you doing much trading today? It's been a quiet start to a week, hasn't it? Does anybody have any questions about anything that's happened before I go through? You're waiting for the US market to open. Yes. Hello, Bletchley. Good afternoon. So has anyone been up to much? King One Alpha. Hello. Some good new names on the chat. That's good to see. So I'm going to go. I haven't sent out the PDF yet. There's been a delay on it being published. Just check if that is it arriving. Actually, it is. Just bide with me a couple of minutes just while I do something with that. If I can remember what I'm doing. It's the export, isn't it? File export. Reduce file size. The wonders of modern science. 28th of May, isn't it? Looks like I've got a delay on that. Right, I'll try and send that out later, straight after this. So we'll go through it as it stands. Andre Gallo, hello, Uncle Planty, brilliant. Raba Mebratu, Yusuf, hello there. Blah, blah, blah. Rate cut possibility in June, King One, for the US looks like an absolute no-no unless we get a mega weak piece of data at the end of this week in PCE. But I think net they would probably vote to not do anything. They'd want to see more than 1 month of good data. July is a potential if the data helps, and more likely September, the way things stand. We will have a look at CME if I get a chance. It's asking me to log in. I'm already logged in. So I hope you all have that. We've talked about it a number of times before, the CME tool. We're having trouble logging you in. Well, there's a problem with the CME tool again, so we can't look at that at the moment. But I'll have that. I'll put a screenshot up of where that is later on. And if anyone else can log in, that'd be great. It's like the mighty sausage. Okay. Astro Gumbo got the mate on the speaker on in Working Truck in Louisiana. It reminds me of the old Convoy movie. You have to give everyone a beep out and a shout out for me. Right. So where were we? Any questions that anybody wants answering later on in the piece? If you just put them up on the chat, then I'll try and deal with them. But start with, we'll just try and run through the preview a little bit, and then we'll go through some of the charts up to date. I'll show you them how I'd had them for the preview, and then how we've traded since. Like I said at the start of the preview, when you see it, what we were doing, we should have had a bet on when the UK guys were going to go for election. It was pretty obvious, wasn't it, in hindsight? They'd been making a play for they were going to get inflation down, and they managed to do it just on the 1 month when it was going to be the biggest for the year. They made the mess up of going, even though it missed expectations, but they're going to get kicked out anyway, so it doesn't really matter what they do. But they have, what that did do on that inflation thing was push back the UK rates, but we've had 2 bits of data since that have clouded that a little bit. The PMI missed, and also the retail sales on Friday, which we'd kind of anticipated previously because we'd said it was raining so much in March and into early April that it was almost nailed on that there'd be further retail sales problems. Footfall was through the floor. It'd only been held up by garage forecourts previous to that, so it wasn't a big surprise that they came in really light. I'm trying to put together a short all about my pet hate at the moment, which is that FOMC minutes, which I keep going on about, but it just keeps winding me up about how little people have done it. But actually, that is where the opportunities come for us. That whole point of us looking at fundamentals as well as technicals is to look for when the market is wrong. And this is a clear case of when the market is wrong and trying to backfill data to fit their own narratives. We've demonstrated last week, and we'll do it again today, where things like gold and the dollar were already in consolidation setups, and people were scrambling around to find reasons for it, and they're trying to use the rate push out in the minutes as being a reason, but that had already been in the public domain and dealt with, and is a kind of an anomalous reiteration of it. That's what gets you the backfills in the technicals, gets you the retests, the retracements. So we shouldn't knock it. We should just embrace the fact that by doing what we're doing, we're all over every little bit of talking head, and we've got our own picture built up ahead of the game. And that's what I encourage you to do. That's why you should journal. You should journal your fundamentals and technicals as reasons why you're doing things and maybe why not to do. But it's very important that you do keep on top of it. You have a few days off, and all of a sudden you can be out of kilter with the technicals and the fundamentals very quickly. And that certainly seems to have been the case there. The dollar situation, we've been looking for that double correction up to the equal legs and then for it to roll off, which it's been doing. Interesting data came out on Friday in the CFTC positionings, and obviously dollar yen has carried on going long, but GU and EU have both been added to on the short side by the speculators, the hedge funds. And net that has put the DXY net positioning tiny short, which on the face of it doesn't look like a lot. And when we look at the graphs, it's not, but it's different from it being the other side of the line, and it's certainly starting to fit in with what we've been talking about. I said gold. I was asked a question by Deva A, who's on our chat, about whether the Taiwanese situation would be an issue. But I said we started talking about that on Tuesday last week. The tweet started, remember, ahead of target results. We had the Taiwan-China Straits early exercises. I said, why is gold not reacting to this? This is a proper geopolitical issue. And they carried on pushing it throughout the week, quite likely as a response to the US having the biggest stock in NVIDIA and how exposed that is to Taiwan. So not surprisingly, they've totally surrounded it and showed how they could move in very quickly. So, and you've also had Israel doing naughty bombing against, UN reasoning, and you could very easily see the geopolitics come back into it, but they're largely ignored. So it's very much a case of these things aren't direct correlations all the time. They come in and go out, and we need to know what it is. And you're quite likely the moment as gold price particularly rallies, people will be putting it in, aligning it with the geopolitics, and they'll be aligning it with the FOMC minutes when it's coming off, when really it's in a pattern that we'll look at again, which is fairly obvious from the technical side. Indices, I don't know, did any of you manage to catch the pips and pints with Moisey, etc.? There's some good stuff, funny stuff in there. There's also some serious stuff. One of his kind of funny phrases is the key to humor is repetition, as he tells you the same joke for the 20th time. But that's also at the heart of what we're doing. It's repetition, consistency in positionings and the ideas. And that's why we keep repeating the 3, 4, 5 indices setup, because we're getting towards the top of 3s and we're in 4s on a lot of them, with another up leg to come before that whole thing repeats at a high degree. And we get bigger moves and bigger chances to profit. But net, we should be buying indices, and there's another reason for that. And it's not the fact that I'm dyed in the wool bullish. It's the reason underneath why they're going bullish, and that is earnings. We've talked about it before. Earnings growth trumps everything. That's why the rate cuts don't really matter unless it's to help protect the growth. We haven't really rolled over yet in the States. And if earnings are going up, then it's justifiable that they should be highly rated. So multiples going up because the earnings are going up, not multiples going up and earnings going down or sideways, which would be a different thing and would be very bearish. So let's, for instance, you've got a PE of 20, which an earnings of 2, then you've got a price of 10. If the earnings go up to 4, in order to keep the multiple of 20, you would have to double the price level, so which would make it a very bullish scenario. And we're sort of at the early signs of that. So there's a reason to be buying equities, because just to stay in line with its old rating, they need to go up. What is interesting, and the reason why I think after we have this next little move up, we might consolidate, is because we're about to get some breadth. Breadth is when you start moving out across the market cap rather than just the Mag 7 and another large cap tech taking us up. We want to see other sectors bouncing, but it's a classic of be careful what you wish for. If you've got heavyweight stocks that are doing all the work, and then all of a sudden you're going to start selling some of those to lock in gains and buy the lower valued ones, what do you think happens? Well, overall equity inflows stay bullish. The markets probably are bullish, but you will get a short-term pullback just by, and that's a bullish pullback. And this is why I keep saying it's 3, 4, 5 heaven, because you're going to get wave 4 pullbacks that you should be buying, because you've got fundamental earnings strength and you've got rotation causing the sell-off. So that would be an absolute classic. Nvidia and a few just coming back heavy weighted, and then you're buying lesser weighted, less impactful stocks below, but the net overall is still everybody invested. What could derail that? Some out left field, big geopolitics, or some really bad data. We're not getting either really at the moment, but this week is interesting because we've got PCE. And if anyone remembers back, we've done a couple of short videos and longer pieces on both of those. And this week you got 2 goes at it, which hopefully you can see that change in chart. So PCE personal consumption, 2 goes at it. Thursday's GDP data has core PCE prices index in it for Q1, and that's the second estimate. So by that, that's looking at PCE, how it moves on a 3-month basis, a quarterly basis. Now, if you remember last month, that caused a bit of an issue. I'll show you the page in a minute, but having been 2% for Q4 23, the first estimate for Q1 came in at 3.7, and then that automatically told us that there was going to be a problem on the monthly build-up from the actual PCE monthly things that the Fed looks at. So either January and February were going to have to be revised up, or the March figure that we were about to see was going to get revised up. As it was, luckily, it was the January and February, so the headlines didn't move anywhere, and the markets took it quite sanguinely, quite in line. No real dramas. But that has left us in a situation where this week we get the second estimate for Q1 GDP. That number will be adjusted. We need to see what happens to that and whether there's going to be any read-throughs to the Friday number. Now, the Friday number itself is again in a position that we talked about on CPI a couple of months ago, that not all data is the headline data. So inflation numbers, most forecasts, most economic diaries have got them in to 1 decimal place. So for instance, for the monthly figure for April, core PCE, it's spot 2%. And last month it was spot 3%. Doesn't sound very much, but the actual 2 decimal place estimate for this week or for this month is spot 2.4. Why does that matter? Does it really matter? Well, it does. If you could have a very slight miss to that by 0.01%, coming in at spot 2.5, spot 2.5 and above gets rounded up. That would go up to spot 3. So everyone would look at the headline and say PCE, the Fed's favorite inflation. That's missed. It's missed by a 0.1%. Big miss. That equation. Equally, if it comes in at spot 2.4 or below, it will stay at the estimate of spot 2. It would have to be below spot 1.5 to actually cause a downgrade or a beat to estimate. So, all those numbers aren't necessarily what they say. We need to see what actually it is to two decimal places below the HUD to actually have an idea. So there's a very good chance we get some very confusing data. It could either be weak and not noticed, or it could come in higher and not actually be that much higher. And the difference of spot 0.5 on a yearly basis, if that was repeated for the 12 months, that would add spot 6 to the inflation number for the year. So it is really important. That's why you will get a lot of volatility sometimes until the economists have quickly dived in and looked at the underlying data. Well, we'll try and do that as quickly as possible. If anybody can spot that or hear it at the time, it'll be extremely useful for everybody. So that is the main data points for the week, really, in the States. The other one is today, which comes up a bit later, the Case-Shiller index, which is in the preview. Let's have a look at that. Just while we're here, that is the net positioning for the CFTC data from Friday, which shows you the longs increasing on UJ, decreasing on GU, decreasing on EU. The net effect was to take us back into negative dollar positioning, and it was all done by the leveraged fund guys going a bit bigger. So that's why I say Friday night looks boring. It's actually that's some of the most important data of the week, and delving into the CME reports at the weekend just to see very quickly where people are, which actors are playing, and what the net positioning is. Boom, boom, boom. Right, here we go. Case-Shiller. So you can see here, house price index was down, and then this is important for US CPI, which is why the whole thing may suddenly start crapping out, as they say, drop into the downside. We're only just seeing the owner's equivalent rent, the made up figure in CPI, starting to fall, when all the real-time indices on rental figures are negative and down. What is this? So owner's equivalent rent is made up based on house prices. So this period in 23, when the house prices were going down and all new rental contracts were being estimated, hasn't fed through the CPI data yet. And then since then, Case-Shiller has gone up and has also been downtrending. So all throughout this period, there'll be new rental contracts. So the net of all these here should be falling rents and falling CPI, and it hasn't really come through yet. But last month, we just started to jump up again in Shiller. So one or two people are worried that down the line, it may be short-lived, the actual rental pullback in CPI before it goes up again. So no one's really looked at house price index with any interest since the GFC, really, because that was important for the subprime crisis, but it's now going to start becoming important for inflation data. Vivek, hello, namaste. Who else we got? Are we accepting US customers? That's for Alex on the main chats. Blah, blah. King One, can war influence a US rate cut or hike? Well, it can if it affects the data. If it stops, it depends what it comes from. If it's war with China over Taiwan, then that's a disaster, because a third of the world's trade actually goes through that strait of water. So it won't just be a case of the semiconductors being cut off, but a lot of trade will say that you would get emergency rate cuts on the back of that. So that's Case-Shiller. Hopefully that is clear what I'm talking about there. Those Japanese inflation data was quite poor today. They're not the full. It's a Bank of Japan core CPI measure that they use, and that missed. So that doesn't bode well for the end of the week. Talked about Case-Shiller. What's coming up tomorrow? Aussie construction work. Household confidence in Japan. We need that. I think we mentioned it last week, but we need that to embed some inflation ideas into people's heads. The fact that their wages are going to pay for the rises, that oil's not going to stay expensive forever, and that they should keep spending. And later in the week, large retail sales in Japan comes out as well. So we'll see whether one is leading the other. There's all of the preliminary May CPIs starting to come through in Europe. They will have a second reading before They're confirmed. They're supposed to jump a little bit, so don't panic if you see slightly bigger headlines. And I think it's pretty much nailed on. Once Nagel on Friday started talking about June, he's the biggest super hawk in all Hawktown, and he's more or less said June's on, but the next one won't be until September. You can tell where the mood music is. So he's basically told his hawk friends to accept June, but they won't let anybody cut rates unless it's warranted until September. So that will hopefully come through as a little bit of strength in euro eventually, in EU, as the US dollar sells off. All the oil data this week is delayed by 2 days, by day. So Tuesday's API is coming tomorrow and EIA is coming on Thursday. Also tonight is the beige book. That used to be important. People don't really look at it anymore because the PMI data are so more up to date, and the ISM gives you a real big read through. But that is sort of by industry sector and company telling you what's been going on in the last quarter and last month, etc. It's kind of worth the reference if you're interested, but doesn't really move the dial anymore. Thursday, really not a lot going on. Eurozone confidence and sentiment surveys, Swiss GDP. Then we're on to usual job claims, inventories, and all the GDP and the core pre-CE read-throughs. Pending home sales, are they picking up? That's a good leading indicator. Then Japan CPI and the Tokyo CPI, that's the most important one of that makes up their CPI. They've also got industrial production. And then, as I said, the large retailer sales, construction, housing starts. So busy overnight for the yen. We just need to see anything inflationary. We're desperate for it. China PMIs. So these national PMIs tend to be the ones that undershoot. The CACSIN ones are the private ones that keep beating. So looking for that to catch up at some point. German import data, not massive. Then we've got money supply for the UK, mortgages and lending. That will probably be slightly flat, I'd imagine. Eurozone, as I said, core reading. We've had all the we've had the big four by then: France, Italy, Germany, and Spain. Canadian GDP, and then we've got the big data at 1:30. We've got spending and real consumption and income data alongside that. It's very busy. And then Atlanta GDP, the thing we showed you last week or the week before, that will update in real time with all the things that come out during the week to show where they think it is. And at the moment, they're running a little bit higher for Q1 than the official estimates are. And then there's there's a couple of interesting things going on technically in the States this week. Stock trading goes to T+1 settlement. So you'd literally have to have paid for it by the next day. That might cause some issues with overseas holders that haven't got their system sorted. So we may see a little bit of a volatile session today and tomorrow in the States, just as things adjust. There might be more selling than you'd expect, just as people are maybe having to adjust to the new accounting regime. But it should sort itself out over a couple of days as people switch accounts. And then bond auctions, we're just used to hearing about what is actually coming to market, what the Treasury needs to do, the government spending funding requirements. But there's going to be some nuances as of this week that they're actually going to start doing some bond auction purchasing. That may cause a few ripples along the yield curve. What's happening there is that some of the longer dated stuff, because it's come through various economic cycles, it's probably no longer fit for purpose for matching by the institutions and hedge funds. So they're going to retire some of the less liquid ones and reissue new bonds which have better matching criteria, different bond yields, different coupons, depending on what people require. So just look out for that. It isn't anything dangerous or serious, and it's been flagged well ahead, but it might just cause a few strange auction prints this week. So any questions on any of that before we have a quick look at the charts? So Rob Mabratu, are EU, GU and gold completely opposite with DXY? So do they have an inverse correlation? Well, generally, yes. I mean, they're the divisor of all three. They're all relative to the dollar by definition. So you will see that DXY itself obviously is made up of a number of the dollar pairs. It's about 60% of EU is in DXY. And then UJ is quite a big proportion. and then various and Sterling as well. GU. I'll put a list together of what those definitions are, those proportions. So yeah, most of the time you're looking to see what the DXY is doing to start with. And originally, like I was saying, that FOMC situation got us everything we needed. We're in here saying it looks like we're probably going to do a double. We were on the spot 618. I wanted us to go for the double up here before it reversed. We got there on Friday. We talked about the old, it's fulfilling the one more turn, Del Boy, and we'll go into the update on that later on. So now it's a case of, are we in the sell-off, or is this just a connector again for a double to take us into the above towards 105.5 before it really sells off? We have got quite a mixed week, so we could have a lot of sideways trading. Will that actually bounce? So the key thing to look out for is how it reacts at the equal legs on the way down. That will have broken the previous pivot point, in which case there's a good chance that it's now in an impulsive move down, and we'll know that if it gets to 1.618 and beyond, because that will be a proper third wave down there. You'll have a one consolidation, and then the third wave will be impulsing, given an overall third wave move to this. So that is what to look out for on DXY. But generally, especially now that we've got the faster money on it, I think we're looking at the start of a proper test of 104, like we said last week. Look out for that. Yeah, I mean, the exact. Thank you, Al Hadithar. We'll look at the full basket another time. There will be small bits of lots of the peripheral currencies. Dave Land, sir. Not sure what the next bit is. My understanding is if Fed starts cutting interest rates, then DXY should continue to go down long term, isn't it? Remember, you have to get used to consensus as well. So people will have a feel for how much the dollar's going to go down based on interest rate differentials. And at the moment, we know that it's sort of priced in for 1.5 cuts by the end of the year. Blah, blah, blah. Okay, good, Vivek. We will have a look at that in a minute. And there's other things at play in the dollar, obviously, with it being the reserve currency in the world, and then the de-dollarization funded deficit issues. So it's not all clear cut just to be rate cuts and negative sort of rate cuts with the way that the economy is set up and the potential need to defend it may have a bigger impact than just saying if rate cuts come off, the dollar will go down, because you may actually see flows back into the US to buy US assets to offset it a little bit. Again, we'll do all catch-ups with these. The idea for the week was that gold was a 5-wave move down in the end. We had a number of setups that could have been 3-wave consolidations and then double extensions, but it just kept going, and once it took out that order block support, which we talked about, it started getting impulsive. By impulsive, you're getting big, sharp moves down. Starts to tell you that that's something bigger, and the fact that it was in the middle part of the whole thing, impulsing in a third wave, it kind of it became inevitable that this was going to be a 5-wave down. Why is that important? Well, if you've got 5 waves down, then whether it's whatever it is, whether it's bullish or bearish, you're going to have a consolidation, which is 3 waves, and then another 5 down. And we've had a bounce back yesterday. So that basically said, as soon as the 5 are in, we talked about on Friday, whatever's going to happen next, we're going to have a bounce. We've had that bounce. Has it reached the 2360.80 level that we talked about? We got just shy of 2360. So I said, that you can either have a connector there and another equal legs to get it into that zone. And the trend channel from the previous high through the first low, the first day wave low, is suggesting that 2380 is an interesting stopping place. And we'll have another look at a retracement level on that in a minute. But what needs to happen is the 5-wave low needs to hold in the short term. We don't really want to go much more than a 61% retracement. And then hopefully it puts in a second up leg, and then the equal legs A equals C of that whole 3-wave move down would be around 2250, and that matches up with the bottom of the trend channel. So that's kind of interesting confluence. I'm sure we'll have a look at that in a minute. Silver, again, we said it's been outperforming. That looks like it's a third wave as well. We're looking for a 3-wave consolidation, of which we've had a down, a bounce, and then that is probably selling off again today. Again, 28.50 kind of level is what I'm looking for. I'd like to see a break of that support, and we'll try and pick it up down here, because that is the one really to play on the breakout. If we resume the uptrend, once we resume it, silver will zoom again. You saw that last week. It's been the outperformer versus gold. Unfortunately, it means it underperforms a little bit on the way down. Indices, they said, now they're all in the sort of 3-4 patterns. We've got almost what looks like an equal legs zone taking place, but we could really do with one more tiny little low just to make this here a 5-wave finish to be nice and neat. And then we've got one more decent rally in us before we start putting in these consolidations. But as we can see with the Dow, that looks like it's very much in an early part of 5 waves up to get to the next main high degree wave finish. So a little bit choppier in the Dow, but it gives us quite a bit of range trading to play with as it grinds higher. The S&P is the one that slightly worries me. The momentum has gone out of it in terms of the divergences on stocks trading above 50-day moving average here. He's still around the flat line 50. We talked about the 200-day moving average. People are highlighting it as maybe a sign that momentum was giving up. That looks like it's playing out a little bit. So we're flatlining, looking for new high, diverging against some key underlying momentums into very low volume up here. That's probably got one more smaller high, potentially a couple of percent. We said Friday, plus or minus 2% for some of these things in their 4th waves. And then once we break to a new all-time high here, start looking for a reversal. It's dangerous still because these things are more likely to extend in impulsive third waves. So you're taking on with a chance. Make sure you have tight stop losses on those, because this thing could get infinitely more impulsive. But the idea is we are actually looking for some consolidation in here. Range trading, you can see, look, very circular with the 3, 4, 5s before we break out into this June-August path properly to put in a high for the S&P. But that one looks like it's overdue some kind of pullback now. It's losing momentum. NASDAQ, a little bit tidier, but again, until we put a new high in, I haven't set, we're going to look in a minute, that is suggesting that it may have done a 3-wave 4 consolidation there, nearly got to a 1-for-1. Ideally, to be clean and set up and give us a chance to buy, I'd like to see another down leg for 1-for-1 back down here at 18,500 and then go. But are we going to be that lucky? Again, I want it to be ideal because it would stay and be in the uptrend channel that we've been playing with. It'd be rather neat to get a 3-wave that comes and touches that before it goes up and breaks the ultimate 5-wave channel to put in that top. It's been a lovely index for us on the fibs and the levels. It's been behaved very well. Let's hope it finishes that way. Don't really want to get caught out right at the top, but be careful with all of these. There are bigger opportunities ahead for purchase and breakout. In here, we need to be careful and be tight. And something I mentioned in the preview, if you have got the money and you've got PA money that you can drip feed in, you should really be buying into all these dips, because I think it's still a decent opportunity for good upside into Q2, Q3 crossover. But if we're trading, we're using trading biases and tighter daily ranges, then we can't really afford to carry like that. So we need to time. The DAX, again, that has been playing out a rather neat ending diagonal to put in a 3-wave into that 4 low, equal legs. It's bounced off it lovely. Again, this could be a consolidation. Then we have another 3-wave. But looking at the gradient of how that's all played out, it will only be a slightly lower low than we've put in for what looks like the wave 4 already. If anything, I feel like that might bounce out. The aggressive fibber, yes. So 5 and 10 year seasonality. Someone else was asking about this the other week, weren't they? With using Kondratiev waves and other cycles. Yeah, I don't put anyone off it, and it is another angle to use. It's normally there as another confluence and can often signal when you've got that in line with where you have turning points, either end of 5 waves or the end of 3-wave consolidations, and they really can be powerful over time. Yeah, commodities to me really follow Elliott waves quite well, to be honest. So yeah, I wouldn't put you off that. FTSE, I know Edward was playing around in this red block earlier. To me, that looks like it's already put in at the maximum that we would have liked to see for the 4th wave. Didn't react at all well into that Thursday sell-off. So I kept wanting to get it below 8,300 for a buy. We've got it. If anything, I feel like we're just going to consolidate. It seems to be ahead of time. The results are out of the way. It's not the leading index. So unless we actually break that current low, which would be quite negative actually, because then I think we'd put in a double. Then you'd be back down retesting the 50-day moving average again down here, which we don't really want to do. Probably would break that short term and then reclaim it. But I'd like to hope we just go a bit dull in the FTSE and hold in this zone, and then it will catch up with the other indices. The Nikkei, we were talking about that. I can't remember who was asking, but we had that 3rd wave of 5 on the left. I don't know whether you were talking about that or the 3rd wave in this channel. But this was, to me, going to be a set of 5 3 waves before it puts in a break of the channel 2nd wave, which we're looking to buy, because within that, we're very noisy, and you can see how many times you've been reversed both ways. We started looking at it down here. The reason that we went for that as being the 3rd wave is you need the 3rd wave to be longer than the 1st and longer than the 5th, or basically can't be the shortest. That rule still applies even though you've got overlapping waves in the leading diagonal. So that kind of fits. It's all valid now. Now it's just a case of which 3 wave is the 4th low. It could be valid that we finished at the top and we're about to break down, or we've got one more little move up before a consolidation. This week should probably be choppy. I want to buy the pullback that breaks this bottom trend line. I think that's going to be a powerful bounce off when that hits a 3 wave. So I'm going to be patient, which I've been advising all the way. We talked about EU maybe benefiting from some of the dollar sell-off. Again, within here, we've already had a move that is an equal wave, almost an equal waves too, but I'd like it to touch it properly. So I'd like to think that we're in a consolidation first. It's got one more little sell-off before we go in to the more aggressive 3rd and 3, 4, 5 waves up to put in the middle 3rd of this move, which again gives us loads of trading opportunities to get in and out before we hit the 110 barrier, which we've been looking for a while. The fact that the rhetoric around the EU is getting ever stronger to being 1 and then a pause. Nagel and someone else today saying, who was it? Francois Villeroy was on the tapes today saying they should be doing 1 per quarter. So if they do 1 in June, that means 1 in September at the earliest. That might just be enough to get this bid back into the EU. It would certainly suit the setup. I don't think the setup finished here. I've seen some people suggest that is the 3 top. I don't think it is. I think we've still got a bit of churning to do before we get there. So keep your eye on that as we go through the data this week. PCE isn't expected to be a miss in any way. So that is hopefully going to be an inline print that doesn't cause any ruminations. Lati Yahala, does the DXY represent the US economy? Well, to a certain degree, yes, because that is the representation of what the dollar's doing. But remember, the DXY, the dollar is the global reserve currency, and it's the biggest. It represents also the biggest amount of debt in the world. So a large part of the world is short the dollar by definition because they're borrowed in it. So it's a combination of where all the flows of the dollar are, not necessarily the US economy per se. Yes, it is affected by war because, in general, and this is why it might not be the end of the dollar this year, but it might be coming sometime soon. But in the meantime, if we get any major outbreaks of geopolitics, people rush to the strong currencies, like the yen, the euro, but particularly the dollar. The dollar is the first safe haven. And often that is because of people going into bonds as well. So they have to buy US dollars to buy the bonds. So you get the whole ripple through effect, which is why the dollar often is more overvalued than it should be. And that is the main reason why they came off the gold standard in the first place. They didn't think that their currency was relating how much they were bailing out the world with their dollar issuances. Unfortunately, they've devalued it way further than anyone ever imagined, and now it's almost worthless. UJ, again, we've had the commentary, interesting commentary yesterday on Bank Holiday. They have their annual Bank of Japan conference. Star guest speaker, probably not someone you've heard of before, but a chap called John Taylor. He's got a thing called the Taylor Rule, which looks at all the macroeconomic data and estimates where the neutral rate for central banks should be for inflation. This is the thing that in the States they're going to consider whether it should be a little bit higher. And in Japan, for sure, his work says that there should be high rates, and hence they're talking around that. They were saying yesterday, some former members of the Bank of Japan saying they've got enough room definitely to go to at least 0.5%. And Ueda saying that they're hoping to embed those inflation expectations, and the deputy governor saying that definitely this time it's different. So that was a maximum full-on talking heads version of Bank of Japan to say that everything in the background is going to suggest higher interest rates, but it's whether the market believes them or wants to take them on. And we talked about the setup on that pattern looking to break out. I think it will, unless they actually do act, and then it really depends on weakness in the dollar happening, which we think might start to happen. So we might have a bit more choppy pattern in this, but unless some of those fundamentals change, we are going to see a challenge of 160 again, if not a new high for this move somewhere in the upper part of this blue channel before that tops out. I think we'd get an actual interest rate hike if we got up to 165 kind of region. I think they would just blatantly have to come out and do that, and maybe even 0.5%. So look out for that. But the market is probably going to test them. Will have to be an explicit intervention. What we did say last week was the dangerous one is if they do what's been threatened, and that's the US Treasury sell-off. Then we'll start to see a little bit of interest for the DXY. How that will probably, rather than a flight to quality, then you would see a proper scared sell-off in the DXY. Bytes just joined. Planty, do you see the dollar being dominant for a large part of this century? Given if the dollar goes down, the global economy by and large goes down. It's interesting because obviously we know we've got the BRICS guys trying to create their own currency. And who was it? I think it was Janet. Was it Janet Yellen or one of the others? No, one of the other talking heads. It is written down in one of the previews. Was having to comment about the future of the dollar, and they said, regardless of why or how, we have to respond to the fact that if it could happen and what would cause it. And they're in the background, they're very aware that the dollar is under pressure, and there's a very good chance that it loses its status. The fact that gold is now an official reserve asset, the only other thing to the dollar with the BIS, the global settlement system, then moves are already afoot. So that makes the whole job of the BRIC currency using gold as an alternative a lot easier, and puts America under a lot of pressure because they might not even have all the gold that they reckon they have. So, like I say, if we have a catastrophe in a geopolitic issue, the dollar may get away with it to start with, but I think in the medium term and over this century, it's going to lose relevance, and at some point we will go back below 100, and we'll see how we react from there. But it's going below 100 may cause things to come to a head. It's all you can tell that there's something new coming, that every central bank is testing digital currencies. So there is a new deal coming. There has to, at some point, unless you revalue the dollar as I presented months ago now, that's something ridiculous like $100,000. you can't clear that debt in the US. Now, it might get revalued to 10,000 by the Chinese and the BRICS at some point. They dominate the supply. They're going to dominate the settlement of it. So the Eastern prices will dominate over all the paper prices in the West. So there will be something big coming. So yes, the simple answer to the question is the dollar won't stay predominant forever, and it is probably in its death throes. They've abused it since they came off the gold standard in the 70s. But floating currencies, remember, futures and Forex didn't really exist until the 70s. We've all lived through seeing them day to day, but they weren't there before that. So a return to that environment, and having been on that kind of standard environment for 400 plus years of modern day industrial world, would it be a surprise to go back to something that is pegged? Not really. You'll just have better tools to control it. So GU again, I think GU possibly is slightly ahead of EU on the technical setup. That's probably got its fourth wave in. The fact it's gone to a new high, that probably just keeps grinding until we get a data differential. But that could come as early as the end of the week. That could extend further there. The other thing I want to just say, we all talk about the VIX, but there's a bond equivalent, which is called the MOVE index. As you can see, they're both at multi-year lows, multi-month, yearly lows. Is that dangerous? Is that scary? Not really. It's just showing you that the implied vol is low. We're in a kind of trending environment. Pretty much the reason for it happening in the bonds is that we're stuck between 4 and 5% on the 10-year. Very little movement likely unless we get a blowout in the data in any direction. The 2-year is where more the short-term volatility is going to be around rates. So unless these things go really extended further down, I don't think they're telling you you've got big inversions, but I would expect to see a much lower VIX print coming soon as we go into these new, the fives of the 3, 4, 5 heaven. And then that should be the turning point that gets us a consolidation back into this sort of 16 to 20 level. Al Adheath, yes, obviously, yeah, it needs coordination. It needs to be from the people. I mean, Gaddafi, yeah, peripheral figure, peripheral currency in that. We've talked about the ZAG. No, it's not. It's the ZIG, isn't it? The ZIG in Zimbabwe, the Zimbabwe gold-backed currency. They're making their first efforts to take on inflation by having an asset-backed currency. But the BRICS are openly doing it. They're setting up a blockchain regional finance banking system that will ultimately require a backed currency. And when you think about all the data on gold that China has, way more than just its central bank reserves, probably 4 or 5 times within the country, and that makes them the global dominating holder of gold in an environment where the majority of gold trading is done in paper form, blah blah blah. Then that price is subject to massive movement, and once that starts happening, they can start realizing their values, and they'll pin it at a level which is beneficial to that region, and that will be a lot higher than what it is here. So that's the preview. There's very little left on the earnings side of things. Salesforce, probably the biggest name. Dell will be interesting. Might have some updates with that idea on AI computers with NVIDIA. Costco, nothing on Friday. Talking heads. Already we had the MPC pill yesterday, yet again saying interest rates are way off, but that's his standard remarks. Even when bearish stuff comes out, he's pretty hawkish. Philip Lane, on the other hand, for the Eurozone, talked to the FT yesterday, and he said that rates need to remain restrictive as they don't see inflation coming back to under control properly until 2026. But he also reiterated that there is enough data to start cutting now, but they will keep it as restrictive as they can as they move along. So hence, there won't be a bunch of sequential monthly cuts, is the way of reading that. Nothing from Mauder or Williams yesterday, even though they're on the tape. As usual, go through everything that happened last week. And within that is the talking heads. It's well worth making sure you read those, particularly what happened with the FOMC last week. We need to know exactly what people have been saying in the interim period and not what they said 3 weeks ago. Yes, repetition is the key to humour. Boom, boom, there's a diary at the end. So, yeah, so the reason they're moving away from SWIFT and global banking systems is because they're scared stiff of what happened to China, what happened to Russia. So they definitely want to make sure all the BRIC gains are kept within the BRIC region and that the US can't weaponize them. And it's quite interesting when we're talking about fundamentals and how people can backfill, like using the FOMC minutes. What actually did we have coming out? Where did I write that? Last week, in terms of things that might get used to backfill. So NATO, there's lots of chatter. There's only the UK that allows Ukraine to use its weapons for operations inside Russia. Most of the NATO countries have forbidden that, but as this drags on, they might get pulled into doing that. So that would be a big geopolitical change. Israel keeps pushing back against all the warnings to behave. That could explode. We've talked about the Taiwan situation. So all these things at any stage can escalate and go a different way. Obviously, the fact that the confiscated money from Russia is now being used to either rebuild Ukraine or pay for the weapons by the European and American banks and obviously governments that hold it is not the most tasteful situation for creating any kind of peace going forward, is it? Not helpful in any way, but these things can be built as a narrative that equally easily support your geopolitical pushback and will get used in gold for sure. Right, let's just go back to the charts and what they've been doing in real time then. So again, we've got the Dow on the daily. Is it pausing here before? I mean, normally when you get the pause, it's probably putting in a double. So we might get that extra little push down that we were looking for before we take off to the one and then put in these grinding, flip-flopping, trading range type action. Still hasn't broken through to a new low yet, so it's just stuck within the whole range, isn't it? What's going on there? Just going to refresh that. S&P, again, on the daily basis, we're talking about, is this going to do a double again? Is it going to roll over completely? Have we actually put in a fifth wave there? I mean, there's half an argument that you have, but it doesn't look strong to me. That looks more like we'd move the 3 to there, and we're doing a potential double 4 here. So that could actually move across. But that gives us one more high. It's all about how we react. I think we're in choppy trading this week. All I would do is, whichever way it goes, I'd play with a tight stop loss for either breakout to there or seeing us finally roll into the next down wave 4. But at the moment, if you look at that on the hourly basis, that looks like it's about a 1 to just over. So it's down here, 1.236, one spot 4 maybe, and it bounced. So it's well within its normal areas for being a 3-wave. It's really all about how we react here. Go out of 1, then we've had an extending 1, 2, 3, 5, 3. So yeah, that's got every reason why that could be done for the moment and come down here to put in a double. But equally, it could just be a shorter pullback and we carry on. Don't know. I want to see more data. It's a no trade for me at the moment on the S&P, and I'm not. If anything, I would play a short with this current high here as a stop loss, just because we've been talking about that falling momentum. Very short term, we could just get a little bit of nervousness as this week goes along before we put in the next 5th wave that we were showing on the larger chart. So yeah, just be careful. But again, or definitely just play that as a stop loss rather than letting it feed into here. You could ultimately have the previous high as a stop loss. That's quite a much bigger one. But then there's danger that you start talking yourself into not letting that play out, just psychologically. I think if we start breaking this pattern here, then it's probably going higher. NASDAQ, that's not really done a great deal today either, has it? Still more or less flat. It's one of those annoying situations. We're in the 3, 4, 5. Do you want to be buying it for what looks like a small further upside in our game? Then it's pretty decent. And obviously down here, that previous low is a stop loss, but it's like we said on Friday, you're pretty much in between the range. Are we looking for a trade rather than one jumping out at us? Again, it's a coin toss. Failed. It's just failed at the high there, isn't it? Obviously, if we put in a new high here, then we're into 5 waves already of coming up to this stopping point, 19,400. We're kind of looking for, but if that breaks out into here, with a 1 reversal, 1, 3, 4. That's a 3, 4. Very shallow. They're all very shallow consolidations. It's an extending wave. You'd expect there to be a pullback at some point into here before we go higher. So you're playing again with small upside. Just make sure that you use whatever the previous low is for consolidation. But again, because you're in here 19,000 and looking for 19.4, do you really want to be selling? So you've got the previous 3 high, minor wave 3 high, just up here at just short of 19,000 as a potential sell. 19,000 as a stop loss, maybe, just to make sure it's just not an overthrow. If you want to play a stop loss, because there's more chance of a bit of 3-wave equal legs consolidation before we go here. So that might be a reasonable setup. But again, we need more data. We need to know whether it's breaking out. We're looking for a trade there. The probability bias and risk reward ratio on this, you'd lean towards putting on the equal legs play before we carry on moving ahead. We're not looking at that one. Right, gold. Let's have a look at gold, because everyone loves playing gold, don't they? Let's have a look. What's our thoughts on gold out there? Yeah, hello, King One. King One. What are we thinking? What are people thinking on gold? Because this is interesting. So this is actually beautiful for what I was talking about. So remember, we've said we've got an A leg in. We've got the trading channel in blue, which is suggesting that the bounce from A to make the B wave, it's either going to be a 3-wave or it's going to be 3 waves with a connecting sub 3 waves and then another 3 waves equal legs, which takes us up here to 2,373. So we had a 3-wave here, which I've actually put that one in. Don't know. Let's go a bit bigger. So the situation is if we put the 3 waves in here, as long as this red line here holds, that I put in through basically, 23, 25, it would be a deep consolidation as a connector. I wouldn't really want it to go much more than spot 618. But what we're really looking for here, and I put it in, let's move it down to there. That marries up lovely with the spot 618, the equal legs for the first 3 waves, following what looks like a connector, takes us up here, right onto the top of the channel, equal legs 2373. So that's a beautiful confluence just from the longer term, medium term setups on the actual pattern. What can happen though is, unless this breakout at the moment takes out the previous high, we could just be setting up for further sell-off. So we could actually see, but my central case in all of this is that this is the start of the second set of 3 up, which takes us to this B wave. Unfortunately, if that doesn't start to become super impulsive and move up to the 1 spot 618 level, which would be the 2390s, that's when we'd have to question it. It's pretty much a connector for the whole move. So we've had our 5 waves down, 3 waves, a double 3-wave correction to make the B wave. And then we're looking for an equal legs, A equals C to downside, which is in there. The A equals C, equal legs is here at 2248. And look, just happens to be around where the bottom of the trading channel is for this whole consolidation. So that becomes, again, a powerful confluence. So we're dealing with, again, if I'd have been on here earlier to do this, would have been saying straight away, and it's still the case, if you want to be a buyer, it's a buyer with a stop loss at the first 3-wave potential connector here. If that low goes, then all we're doing here is we've made a 1, a 2, and we're into this 5-wave move down already because we've already got a valid 3-wave B wave in the middle. So we know that this is a really dangerous position at the moment. We need to break to a higher high to more or less confirm that we're grinding into double consolidation. So yes, net, both of those are going to put us in a position where we should be selling, but I think you should wait until we get into the higher part of this trading channel. At the moment, I mean, obviously there is 10 to 15 full points, 150 ticks on that. Pips, sorry, 150 pips. That's, because it's quite a range to play in. So you'd have to find much lower time frame entry to suit you. But boom, 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 1, 2, 3. Can that pattern actually? So the other thing is, just to be double noisy, we've done 3 down. We could be doing a 3 smaller degree 3 connector and then another 3 down, just to put in what is the overall connector for this move across the channel. So, it's going to be choppy, and we're just going to have to let this bit play out really to have proper confidence in my setup. Needs to break out either way for sure. I mean, that in itself, just like we were talking about in the indices at the moment, that gives you a short-term sell if you want, with a stop loss on original first half of this B wave, potential top of the B wave, gives you a potential sell here. You know what your potential out is there, even if it breaks up here. We've learned something, haven't we? So it's short-term trend at the moment. I think the primary setup is that we're still in the original. We're grinding up to 2370 kind of region, and then we'll test it. To change the pattern completely, we need a break of this 2393 level. If we go above 1 spot 618, then this back here might need recounting, because this probably isn't an A. That was probably the whole wave 4 finish, which we had originally, but we changed it to what looks the best fit looks like 5 waves down, which gives us an A wave. So it's noisy. We've got a good idea on what the pattern is, but in terms of trading it, be very careful what you're selecting versus the potentials. So definitely stop loss here, stop loss here, stop loss at the trend channel, and up here, be very careful shorting if it's getting impulsive. Is all that clear? Does any questions on that? Does anyone have a different view? And then obviously this is a wave 4 at the higher degree, at the minute degree. We're waiting for that to finish wherever it is. It's either finished here or it's finishing at the bottom of this trend channel. And then we are looking for a move to the overall trend channel for this minor wave, red 3, wherever it's gone up here. So somewhere in breakout of the blue channel towards the move for the 3. So massive, massive move when it comes, but it's how long it takes us to get there. Are we still consolidating, or is this all going to be the early stage of that breakout? We won't know until certain levels are, but this gives us a pattern, a number of levels to start invalidating things or to confirm certain moves. So that's where it becomes quite powerful. We know that we're in certain setups. We know that some of them are more probable. So hopefully that is helpful to you. It's a good way. And then within that, you can go to your shorter time frames and use what you see as fair value gaps, order blocks, Bollinger Bands, every other kind of indicator that you may or may not use, just to confirm where we actually are in the move. I mean, what did we look at the other week? Where was the 15? Had a 15-minute one, didn't we? I think I lost that. Yeah, I'll put that on the Market Watch with Planty chat. We can talk about that one on there. So unfortunately, yeah, I've got this drawn on the ICE, which I haven't paid for the ICE feed for the dollar. So my live chart is an hour behind on ICE. So are we talking? Has the DXY now gone down and traded to 104? Has it? Okay, it depends what dollar index you're using. I will, yeah. So you're on the, like this capital.com one is on a slightly different scale. But I'd like to suggest that relative to what we were using, this is very impulsive. So it's confirming what the setup that we've had. There's one way of looking at it, that you've got 5 waves in that, you've got a consolidation, and then have we had another 5, which is the zigzag consolidator. So it'd be interesting, like I've always said, it's going to be interesting now at the 104 level how it reacts, because that either we go to put in double the consolidation we've been having for, let's go to daily on that. So it's now, we've had that double consolidation, which took us up to 106 on this chart. And now it's a case of whether this is a valid connector. Does it need to do more before it goes, or are we actually fully into what is the third leg of this move down here? I'll draw this up again on your chart and on my chart. This seems to have because I haven't got real ice flows. That's making it annoying. So yeah, no, Bletchley, I like that. Put something up on my chat in the Discord, and we can all have a chat on that. That'd be good. The Nikkei 225, we talked about it on the thing. Has it really moved? Hasn't gone anywhere, has it? It's not even broken the channel as yet. Why is that not? So we're still waiting for confirmation either way there. Just wait until we get the breakdown here. No change of view there. Nothing's moved. Oil, I'm just staying away from at the moment. As I said, Biden is going into the special reserve again. We'll be running out soon, but they're definitely making sure that going into, what is it, Memorial Weekend that we just had, I think that is historically the biggest driving weekend, isn't it, in the States? They always like to try and keep oil prices down. And now that it's been so successful in offsetting all the OPEC stuff, they're just probably going to keep doing it into the election. So it's a difficult one to actually play. We don't really know who's in the ascendancy there. What can't happen is OPEC bring any more back. They're just going to have to try and manipulate the price again in Saudi Arabia to try and spark a bit of life into it. It looks very much like a sideways and done for the moment. We'll revisit that. There's obviously chatter today about geopolitics getting a small bid under it, but we'll see what the inventory data says again today and tomorrow. Sorry, it's tomorrow, isn't it? Tomorrow and Thursday. Sorry, Wednesday and Thursday this week. DAX wise, that's started to consolidate that move, hasn't it? Again, important test here on the 50-day moving average. So in order for this to be breakout, we want to see that hold. If not, as I said on the previous chart I'd put in, there's half a chance that this is a consolidator, and we just put in a slightly lower low before we go. I think we've got to get through CPI data in there. We've got German GDP, German import data, haven't we? Not a lot to really turn the dial fundamentally for this. It's just going to follow the other indices. I don't think we gamble. We just need to see how it reacts at various important junctures like this. So we need it to hold and bounce, really, to believe that we're in the fifth wave. I want to see a new high to this first move. That's the definer. Silver, as we said, it's obviously following the pattern of gold, but to a higher degree, to a more leveraged way. So again, this is playing with its high, whereas gold is a long way away from it. Be interesting. I wonder what will happen if silver breaks to a new high, but gold doesn't. Then will that suddenly become the one that will they reverse? Will silver drag gold? But in all, if it sticks true to form, then this is going to run out of steam before it gets to a new high, and we will do the three-wave move down to test this order block again, and then go. Yeah, Haditha. I do apologize for not knowing how to say your name, Al Haditha. For crude oil, it's good to also monitor the tanker shipping market and Platts futures swaps for an accurate view of the current market. Yeah, so we said the other week one of the bullish arguments was that the tankers were empty, weren't they? So there was plenty of room to store. And the other thing was what I mentioned last week is that within the current setup, often when the futures go into contango and the prices further down the futures curve are higher than spot, that's supposed to be bullish if you look at it, but it depends what the underlying reason is. And if the underlying reason is that there's an excess supply and that the spot is going to go lower, then your expected future price based on spot becomes lower, it's below the futures prices contracts further out, so they will attract selling as to take away the arb differential, and that is why oil just isn't going anywhere, because it's just about on the cusp of slipping into this contango situation. And we know that if anything, OPEC have got more oil on the sidelines than being able to do any more cuts. Do they want to do more cuts? That's going to be a really, really big meeting that's coming up in a couple of weeks' time. So yeah, and obviously we've got futures coming out in a few weeks, and we're not going to be doing the calendar spreads, and it means that talking about backwardation and contango, and these are all terms that I will define for people in a series. They're important to know, but the futures are going to be set up in a way that it's front month only, and you'll have intraday trading. You won't have overnight positioning, I think, is the idea. So that will protect you from a lot of the nuance that catches people out in terms of trading the wrong contracts and spreads and stuff. But I'm really, really pleased if anybody wants to talk about the more technical parts of it, because in my opinion, we build everybody up rather than try and bring them down. And we do that and hopefully the easiest building blocks. So any engagement like we're having today, absolutely love it. And please bring me the questions and issues that you want to talk about. So that's brilliant. Thank you, Al Haditha. I'll wrap this up fairly soon. Where are we? So EU up to date. So that has moved up, hasn't it, on the day, as we were talking about. I've had a move there and we've retraced. To actually put that up to date. So if we're going to, it's getting quite a deep retracement here. It's kind of in the region where you wouldn't be expecting this to be a connector, because it's almost, must be 80% of the way. In fact, we'll put that on, because I like to make it as messy as possible. But just briefly to look at that and put in. So it's already gone above that red line, the spot 786 retracement. That's quite a deep retracement for what would be a connector. You'd generally expect it to have stopped around where we were discussing, where it was early this morning. In fact, we were here, weren't we, from the overnight in this bit here. So yeah, this is looking more and more like we're probably into this third wave. We probably expect this to keep on breaking out by pullbacks in EU. It is looking like the 1 for 1. This one looks like isn't necessarily going to happen. So this makes this too low. Pretty confident we've got the too low here now. So we can kind of get rid of that. And we're probably going to, might even test that before we pull back. But somewhere in here, we're going to have a pullback, which we should be buying. So the bias is that the EU is probably taking over on the long side again. And then we get the pullback around the 109 level. Do we get an ultimate finish, 109,600, or can it reach 110? I think the 110 possibly comes later on here in June, but you never know. Subject to the data this week, this might all get brought forward and we'll rebuild it. What's that one? That's a FTSE one there. Let's just check that's updated. So are all the tabs actually changing today? I do feel like we're on the right page. Riverside's behaving today. Who've we got? Nil, naughty, what type of trader are you? So I'm kind of mixture of all types, but Elliott Wave is my fundamental go-to to start with, to look at my different setups at different time frames. So I analyze it in a kind of wave theory way. And I will have other indicators and confluences within that. So I like to use fib, obviously, within it. Look and see where that marries up with order blocks. And obviously, I'm a combination. I'm fundamentals and technicals. I'm not one of these people that turns their nose up the other side. Each one has its period in the ascendancy. It's about finding out who the players are that are dominant. What's driving the actual price underneath? Is the price leading the fundamentals? Fundamentals leading the price? Are they in line? Have we, like we talked about the FOMC minutes, got something that is at best just a revisitation of levels? It's known knowns. We're looking for unknown knowns, known unknowns hidden within the data. Can that marry up with the technical setups? Are the technical setups suggesting that the data sentiment is reading an extreme or hasn't caught up with where the data is? So that's how we try and build it up. So it's a complete mixture. I think you need to know fundamentals and technicals to give you the confidence of knowing when you should be fading or following a trend. And we try and build these things up with building blocks and look at the actual, we'll get under the hood on the data and see whether there's something the market's missing. A bit like you need to be looking at PCE at the 2 decimal places, not 1, because the forecast is bang in the middle. But we've also got a PCE predictor the day before in GDP this week. So it's about Thursday and Friday this week, not just Friday. So hopefully that helps. So yeah, here we are in the FTSE. That's what we had on the larger chart. It went beyond the 1-for-1, stopped just short of the 1.618. So it's still kind of valid that might be the retracement done. And they said, are we consolidating in this path here, or are we putting in if the main US indices are going to go into doubles, and the FTSE will go into a double, and then this is a massive buy if this goes into double down here. So if we just change that to down here. So if you could get the FTSE down to 8,100 and just below, absolute stonking, screaming buy. So I'd love to see that develop. But at the moment, I think this 8250 will probably hold. But again, I don't think it's the leading index at the moment. This is going to follow what the others are doing. I personally don't even know that. Any questions about the setup of the company, you need to speak to Alex about, or George, Ben A. So just to flip that out to the chart we had earlier, hasn't really, all we've got is a bigger candle. Again, we've either put in the minor fourth wave and looking for breakout along with the other indices. So we're towards the bottom of the pattern, and each time we get a fourth wave, it's normally within the bounds of the previous degree fourth wave, which is what we're currently in. So once we break up, we're going to get another chance to buy in here, and again, you're going to get a chance to potentially sell up there, but we're going to know whereabouts we are in the pattern. I'm looking to pick this up in either a retest of what the current fourth wave low is, or as we just discussed, whether we can get a super generous double consolidation down to here before we go. And again, there's an outside chance that fourth wave, when it comes, if we're talking about deep wave consolidations and 5%, so 5% is 400 points from what is going to be 600 to 8,200, which is here for that. Kind of makes sense, but it wouldn't take a lot more to get it into the fourth wave of an even lower degree. So you'll find the bigger you go, in terms of degree, the possible destination for a fourth wave changes slightly. What will happen at high degree? It's a 3-wave down. The end of the first wave is in the next lower degree fourth wave, and the ultimate ending point sometimes ends up in the next lower degree fourth wave, which is that area there. So we'll consider that when we've finally know where we've topped out, because that becomes quite powerful for how we play our short. But I like the FTSE at the minute. The fundamentals are backing it up. It wouldn't be beyond the realms of possibility for it to pull back, but equally this will should fall less because it's a highly dollar denominated index. So if you do get a sell-off that is inspired by a stronger dollar, the FTSE won't sell off as much. Keep that at the back of your mind. Talked about dollar yen earlier. It's in this kind of nesting situation, I think. I think that's a 1-2 and that's a 1-2, which I think is eventually going to build in here unless and this is why you must have strong stop losses, probably at this low here, and maybe and somewhere between the candle and wick low here, is that if they intervene, it'll be a strong intervention and it will look to break back below that 152 original level. And if they do it properly with an interest rate hike, you're going into the 140s. So just be careful. But I think the market will test their resolve. This looks set up to put in a potential new high. A technical question: do I use fib expansion tool for projections? Yeah, I know a lot of people don't, but I do. It's difficult because you're dealing often with things you don't know. So you generally use it once you know what your first wave is, and you put in a second wave. Then you can predict from the bottom of the second wave what the third wave is, and then the reason you do 1 and 1 spot 168 is the majority of consolidation waves are 1 for 1. And then the majority of third waves, and you're now measuring a third wave, if it's impulsive and it's part of a breakout pattern, the majority of them are 1 spot 618 or bigger relationships of that 1 spot 618 golden ratio. So hence once you start getting towards that and beyond, you're in something different and you have to reevaluate. So that gives you a number of good options in terms of stop losses both ways, and invalidations take out whether you're bullish or bearish. And then you're looking for confluences from other things, trend channels, order blocks, MACDs. MACDs are fantastic in terms of marrying up with 1, 3, and 5 waves. In terms of a lot of the time, you get divergence at the end of a move. So the third wave will be higher than the fifth wave on MACD before it moves. That's whether it's in positive or negative territory. So, and then obviously when it's in negative territory, you're generally going to be in a consolidation. So these things all start to give you pointers towards where the overall direction is. None of them are 100%, but we're not trying to get 100%, are we? We're trying to get into anywhere towards 60-40 to have a really good chance. 55-45, we should be making money overall. So is that one clear? And then the last one, has it moved today? That's not updated. So we're doji at the moment, aren't we, on VIX? Hasn't moved. And I haven't got real-time data on the move. But again, like I said, we've said it for weeks now. Until something changes, we're probably range trading in the VIX to ultimately put in another low in around 10. So hopefully I haven't bored you completely to sleep. Oh, we got, I didn't do that. I'll just go back on that. So the British pound we talked earlier, and it has seemingly confirmed that we've got higher highs and looking like breakout. We said we wanted to see this push up here. Where were we earlier? Yeah. I wanted to see another new high just to confirm that we were moving up in that fifth wave, looking for some consolidation when that finally hits up here and it's a buy into the pullback. So the pound and EU are both looking pretty much like they're in the uptrend still. To be super safe, we're looking to buy them on pullback. You can still play this one here. This looks like it's got too far above to be an expanded flat in a fourth wave. You tend to get those different stages mainly. I think having 3 new highs above the previous high pretty much confirms you're in an uptrend. And I'll just go back. Did you see the VIX tab? Probably not. I don't know. So yeah, so there you go. I just said that just looks like we're consolidating before we do one more further fall in the VIX, which should marry up with next levels, top set of 5, finishing off a 3 before we put a fourth wave in, which will probably take us back into this 15, 16 region, and then it's how we react. We should again, I think, sell off in the VIX and rally again in the markets as we put in the 3, 4, 5s. But that's good. This is showing it's not getting overly done at the moment. So we're not into the greed index, and you can tell that from the way the market reacted to the FOMC minutes. That is not a euphoric market reaction. That is a market not quite knowing its direction. We pretty much know we're in consolidations, if not the start of breakouts. Hopefully that is all useful. As I say, carry on the market chat. I'll be there during this afternoon and for the rest of the week. We'll come back on Friday to see where we've ended up with on PCE. I'll probably do that after PCE so that we can all have time to digest it and see the market reactions. But please feel free to contact me anytime. I hope you've enjoyed that. Give it the thumbs up, whatever. And we'll speak again soon. Take care.